Okay, hi everyone. This is going to be the problems video for chapter 1. So let's kind of dig in here, get started. They're starting here. They're giving us some information, right? So let's look to see what's going on. It says, hey, cash flows during the first year of operations for a business were as follows. So they're giving us some cash collected, cash paid for rent, for employees, for utilities. And then they say, in addition, you determine customers owed the company 60 grand at the end of the year. There were no bad debts. Also, the company owed gas and electric company 2 grand at year end, and the rent payment was for a 2-year period. They want us to calculate accrual net income for the year. So what's going on? They're giving us a lot of cash inflows, outflows. That's great for the cash basis of accounting, but we know that in accrual basis that we only recognize those revenues when we earn them, and we only recognize those expenses when we incur them, right? So what's going on here, right? If we were to make essentially an accrual basis income statement, right? First thing we got to do is have our revenues, right? When we look at our revenues, right? Maybe we'll just make them yellow. What are they going to be here, right? Well, if we look at it, we had cash collected from customers of 340,000, right? So we'll have 340,000. Let's see what's going on else here. Blah, blah, blah. Cash paid for utilities. We're also going to have it looks like in addition, you determine the customers owed the company 60,000 at year end, right? So 60,000. Right, so what's going on here? Why do we include these, right? Well, we earn the revenue, right? These were cash sales to customers. They come in, we give them the service, we earned it then. These $60,000 that they owed us, right? These were sales on account, right? Come in, we'll sell you the good, you can pay us later, right? So in this way, right, when we sum, right, our total revenues there, we're looking at 400,000 of revenues, okay? Let's look at our expenses, right? Let's make these blue, okay? So they're telling us here a few things, right? It looks like we paid rent of $40,000, but be aware that was for a 2-year period, right? So we have rent here, but here's the deal, right? It was 40,000, but that was for 2 years. We've only had 1 year, so we've only incurred half of that amount, right? $20,000, namely 40 divided by 2. They also tell us, right, we have some salaries, right? So if we look here, where are the salaries? Cash paid to employees, and those services were during this year, right? So these were expenses. Yeah, we paid them, but we also incurred them during this year, right? 120. And then we also have some utilities, right? It looks like we paid 50 in cash, but they tell us here, right? If we look at it, customers own the company 60. It looks like we still owed them 2 at the end of the year, right? So what's going on here is we used during the year 62,000, right? So it was, or I'm sorry, 52,000, right? That's what we used in utilities. Of this amount, we paid, right, cash outflow of 50, but we have 2 that we still owe. When we talk about accrual accounting, we look at how much we used, right? We incurred, not how much we paid, right? So in this way, right, we're going to have $52,000 of utilities, right? So we sum these up. Oops, sorry. Right, we're looking at $1.92 of expenses there, right? When we take our revenues minus our expenses, right, our net income is going to be 208. Right, there we go. That's on the accrual basis. So it's basically like what's going on. You're going to see this type of stuff in the homework, the problems. They're throwing a bunch of cash items, cash, cash, cash. You got to be able to kind of read into that and dissect it and say, well, what's the accrual basis? All right, let's look here at 1-1. Here's another problem. It's after this is just like little like smaller things. This is kind of the biggest problem in here. So they're giving us some information, right? So let me kind of zoom in here. They're saying listed below are several transactions during the first 2 years, right? So we got year 1, year 2. There looks like we billed some, we collected some cash, we paid some cash. There's some additional facts here. They want to know, can you please calculate the net operating cash flows for year 1 and year 2? This is basically saying, can you please prepare a cash basis income statement? And then they say, can you prepare an income statement based on the accrual method? And then they want to know here in 3, can you please tell us our ending accounts receivable if it was accrual? Okay. So let's start here with the cash method, right? So cash method, what we're really looking at here is, right, we're going to have, and the general rule for cash method is cash in is the functional equivalent of a revenue. Cash out is the functional equivalent of an expense, right? So we'll have cash collected. And let me kind of change this up here because we need to do this for, let's see, year 1, year 2, right? So we'll have cash collected, and then we'll have cash dispersed and paid, right? So I'll just say cash, I'll just say cash out, cash in, right? When we have cash out, there'll be some specifics here, but let's start with it, right? We know we're cash method, cash in, that's what we're looking for here. Hey, we collected cash in $1.60 and $1.90, right? So we'll have 160, 190, right? And obviously, if you're doing this in the homework, you'd put like all the zeros and stuff, right? So there we go. There's our cash in. Nothing else over here seems to indicate anything else, right? So I'll make this just green little dots, right? So we got our cash in. That's where we got it. Now, when we talk about our cash out, oh, here's the disbursements, right? We'll make this, I don't know, pink, right? All these guys, right? So oh, it looks like there was some salaries, utilities, insurance, right? So we will have salaries, utilities, insurance, right? We can just grab these numbers right from over here, right? And we'll put these as a negative just because we're subtracting it, right? Because it's a cash outflow. Insurance of 60, and then just follow the pinks there. 100, 40, 0, right? If we were to sum these guys, I think I put a negative there. Oh, deleted the equal sign, the fun of Excel, right? We're looking, in that way of negative 180. If we sum these guys, right, we're looking at negative 140. Right, so that's kind of the subtotal. Right, let me make these pink, so if you were to pause it, you could see where I'm getting stuff. So essentially, if we were to take the inflows, let me retype this here, and then net it against the outflows, right, we're looking at net operating cash flows, an outflow of 20, if we copy that formula, an inflow of 50, right? Inflow is positive, outflow is negative. All right, just showing us pretty straightforward there. Let's look at it under the accrual method, right? It's an accrual world. Accounting joke for you guys. So here, right, when we deal with accrual method, we don't have cash in and cash out. We have revenues and we have expenses, right? So when we talk about revenues, right, let me move that down because again, we got to do year 1 and year 2, right? Essentially here, we have to look and see what income did we earn, right? So we don't care necessarily here what we collected. We're looking to see what did we earn, right? So we're looking for when did we earn it? Well, it's when we perform the services, right? So we billed, we must have sold on account 170 and 220, right? That's what we, not 179, 170, 220, right? Just to show you where that came from. Then we got to back out our expenses, right? We don't use cash in, cash out. We use revenues and expenses. And again, we're going to have the salaries, the utilities, and the income. But how much do we do for this, right? So let's kind of dig into this for a second here. So for the salaries, right, those were, remember, we only take expenses when we incur them. That was for services rendered during this year, right? So we can use the pink numbers, right? Those are good. Yeah, when we paid it happens to align with when we incurred it, right? So we can use -90 and -100. The utilities, let's check that out, right? They're telling us here we paid 30 and 40. Okay, that's the starting point for utilities, but they're giving us some additional facts, right? It looks like we only incurred utility costs of 35 in year 1, right? Well, we only take the expense for what we incurred, right? So let me kind of, right, we incurred 35, we only put 35 there, right? But if you think about it, right, our total utilities were 70. And if we use 35 in the first year, then to get to that 70, we must have used 35 in the second year, right? So there's a little bit of a, a trick on that one. You got to back into it. How about the insurance here, right? Well, it looks like we paid 60 and 0, but when we look at the facts, the insurance coverage was for 3 years, right? So in year 1, year 2, sorry, that's like not the greatest year there. I'm trying to write with a mouse. We know under the accrual basis, we only take that deduction as we incur it ratably, right? So it's going to be like 20, 20, 20, right? So what that means is in year 1, we did 20. In year 2, we did 20. There's also year 3. It's not shown there because we're only doing a 2-year analysis. Again, so if we would sum these guys, right, we're looking at -145. We're looking at -155. When we net, right, the idea here with it, the revenues and the expenses, right? So we got $170 and the 145. We're looking at $25,000 of net income and $65,000 of net income, right? So you can see there's a difference here in accrual versus cash. In cash, we were at a loss in the first year. Under accrual, we had income in the first year, right? So it's just kind of showing you the idea here, presenting it differently. Again, they're giving you a bunch of inflows, outflows. You need to look and see, when was this earned? When was this incurred? Let's look here at exercise 1.5. This is pretty simple. Some of these are kind of a little bit, you need to think about it. So they're giving us some information here. They're saying 3 groups participate in establishing GAAP, right? So this is for external accounting, not internal accounting. We have users, preparers, and auditors, right? So users, preparers, and auditors. They want to know, and they're represented by various organizations. For each of these below, what is the most likely group they're going to be in, right? Well, the SEC, that's going to be a user of the financial statements, right? They look at those financial statements and make sure, hey, is everything on there okay? We're trying to protect the investors who are buying into the stock market. Next one here, we have Financial Executives International. That's going to be a type of preparer. So they're really, you can look at the PowerPoint there, but the idea is the executives are involved in the preparation process of the company's return. The AICPA, right, the closest one they're linked to is an auditor in the sense that they help establish the standards for GAAP, right? They're really looking and making sure everything is okay and done correctly. The IMA, in distinction, deals more with preparing financial statements. The IMA is more deal with like managerial accounting, like internal, not external standards. So they wouldn't really be involved in GAAP. They'd be more involved with like how do we produce internal standards. Then we have the Association of Investment Management Research. Well, hey, they would be a user of it. They would look at these financial statements and give recommendations or conduct studies on it. All right, so just a little bit of context there for you. Let's look at exercise 1.6. Right, they're telling us here for each of the items listed below, identify the element. Right, so remember we said that you have the financial statements which are comprised of the elements. Right, it's kind of like how the periodic table, all those elements make up the things in the world. Well, all the elements make up the stuff that are part of the financial statements. And really, right, there's some variation of an asset, a liability, or a stockholder equity account. Okay. Now you can look at the PowerPoints for the specifics of those elements, but we're going to go through right here and classify some of these, right? So the first one here, an obligation to transfer cash or other resources as a result of a past transaction. That's a liability, right? You owe somebody money. There's an obligation and it occurred from something that happened in the past. Hey, in the past, we borrowed money, right? We owe money. Next one here, dividends paid by a corporation to its shareholders. Well, that's going to be a distribution, right? That makes sense, right? We distribute the after-tax profits to the shareholders. It's a distribution. 3, an inflow of an asset from providing a good or service, right? That's going to be a revenue, right? Hey, we're providing goods, we're selling, we're doing services. This is how our company makes money. 4 here, the financial position of the company, right? Well, we would have a couple of different things in play here, right? These would be our assets, our liabilities, and our equity, right? Our stockholders' equity. It's really a way of saying the balance sheet, right? The balance sheet is like the company at a point in time, but the elements there would be the assets, the liabilities, and the equity. All right, 5, increases in equity during a period from non-owner transactions. So we'll talk about this in this course, but this is going to be comprehensive income. So you basically have your net income, and you're trying to arrive at a broader point of view of it. So right, go from like your net income, consider your other comprehensive income to arrive at your comprehensive income. So it's a broader view of net income. We'll talk about it in this class as we get closer to it. 6 here looks like increases in equity from peripheral transactions, right? Well, this is going to be gains, right? So a gain is separate from a revenue. A revenue is really the fundamental reason you're a business, right? Hey, we're a cookie company, we sell cookies. A gain is from more of a secondary transaction, right? Hey, maybe we're a cookie company, we get GameStop stock and we make $100, right? Well, that's not really revenue, that's more like a gain. That's a secondary transaction. Next one here, sale of an asset in a business for less than its carrying value, right? That's going to be a loss. right? The idea here is we're selling it for less than what we're carrying it at, right? Maybe we have it at $100, we only sell this thing for 20. The difference there, the 80, right? If you bought a Pokemon card for 100 and you sold it for 20, you just lost $80, right? Again, that's secondary to really the reason we're a business, but it does come into play here. All right, 8, the owner's residual interest in the assets of a company. This is going to be stockholders' equity, right? Whatever's left over in the company. You can think of it like the difference between assets and liabilities, right? If you have $1,000, but you owe on your credit card 600, the leftover, right, is going to be what you really own, right? That's the idea here with the stockholders' equity. 9, an item owned by the company representing probable future economic benefits. That's an asset, right? It's something we own, right? 10 here, revenues plus gains and losses, or I'm sorry, revenues plus gains, less expenses and losses. This is a way of saying net income, right? 11 here, an owner's contribution of cash to a corporation in exchange for ownership of the shares of stock. That's going to be an investment by the owner. 12, last one here, outflow of an asset related to the production of revenue, right? Well, that will be an expense, right? Remember we said we're trying to match the expenses with the revenue. It's related to, we're trying to match it to the revenue. Finally, here we have some MCQs, right? We're going to take a look at this. Let's kind of talk about this here. The first one, it says the primary objective of financial reporting is to provide, we have A, B, C, D. Well, we know, right, that it's to provide useful information. We're trying to provide and make useful information. Remember, we said for it to be useful, it has to be both relevant and faithfully represented. You got to have both of those there. All right, 2, statements of financial accounting concept issued by the FASB, right? Well, these, and if you look at the PowerPoint, you can see kind of more specific detail on this. These are going to identify the conceptual framework within which accounting standards are developed, right? So for 2 there, we're looking at D. For 3, right, it says in general, revenue is recognized when, right, well, we said when you earn it, right, and when do you earn it? Well, that's going to be whenever a good or service has been delivered to the company, right? You perform the service, you give them the good, you earn it, right? It's like when you earn your allowance, it's when you do your chores. When you earn the revenue, it's whenever you provide the good or services, right? It's been delivered there. It's not necessarily when someone comes up and says, hey, can I buy this? Or, necessarily when they give you cash, right? They can pay you ahead of time, right? Here's some money to paint my house next week. That's not a revenue, that's unearned income, right? We'll see that in some of the journal entries. Again, you have already taken an accounting class or two, so a lot of this should be sort of like recalling. It shouldn't be your first exposure to this. 4, it says in depreciating the cost of an asset, accountants are most concerned with, this one's going to be recognizing the expense in the appropriate period, right? If we buy a house, right, for 100 grand, under accrual accounting, you do not get to expense that thing all in year 1, right? Instead, what you do is, say it was like 10 years, just to keep it simple, you would take a little bit of that each year, right? You're trying to match the cost with the usage of that asset, right? That sort of expense recognition principle in there, right? So that's like kind of an accrual idea, right? If it was cash, it would be whenever you bought it, but we're talking about accrual. We said, hey, this more fairly presents what's going on. 5 here, the primary objective of expense recognition. This one is going to be B, right? And this is what we were just talking about, right? It's just kind of a corollary of number 4. We are trying to record expenses in the period and associated with those revenues, right? So we buy this plant, this building in our business, we use this to make revenues over 10 years. we got to associate the expense, the expense, the expense, the expense during that time. Finally, here 6, it says the economic entity assumption states that in the absence of contrary evidence, all entities will survive indefinitely, right? Well, no, that's going to be false, right? That's not really what's going on with the economic entity assumption. We do have that separate thing, right? The going concern assumption that says we will assume that a business will operate into the future, but the economic entity assumption is a little bit different. Right, so those are the problems, right? Some of these you will see as we go through the class are going to be very similar to the homework. Some, right, won't be on the homework. It would be kind of like really boring if I gave you every single thing we did in class would also be on the homework, but you can use this to help you. If you're jammed up on the homework, right, go and look at the optional problems. They're there to help you. Send me an email, right? Happy to respond through email. If you do email me, send me a photo, please, like a screenshot of the problem itself. Otherwise, it might be hard for me to like specifically identify which question you're referring to. So this is meant to help you, right? Take a look at this, watch these videos. I try to keep them shorter, around a half hour, 45 minutes, to give you kind of a summary, high level, what's going on, what are we doing, hear it another time, right? Like I said, accounting, the more you hear it, the more you see it, the better. How you're really going to learn this is like digging in, trying, pick yourself up, try again, pick yourself up, try again. Sometimes with accounting, right, you kind of have to let this stuff marinate. And you could be kind of, it's like solving a Sudoku puzzle, right? Sometimes you kind of have to set it down and then come back to it a half hour later, a day later. The second time you see it, you kind of let it think about in your head. You're like, oh, okay, right? It's a very common experience. Somebody will email me a homework problem and say, I'm stuck on this, right? And I'm like in the middle of class or it's like in the evening or something. There's some time period, maybe a couple hours before I respond to them. And inevitably, invariably, right? Like an hour later or 2 hours later, they're like, oh, I fixed it, right? I saw what was going on, right? So with that, this is week 1, right? We're just getting into chapter 1 here. This is intro stuff. If you have questions, comments, concerns, happy to help you, but I'm going to wrap this up here.